I said, you can ask all your questions at the end of the presentation. You don't have to intervene directly, and you can write your question in chat side as well. As I said today, when we are speaking about the world equity valuation, we are directly speaking about stock exchange pricing. And in every country, you have lots of different stock exchange. In London, you have Russell. In United States, you have Nasdaq, Dow Jones, or different type of the world economy valuation indexes. So when we are speaking about those type of things, we will directly understand that.
Oh la la.
I think there is another problem.
Yes. Okay, I see. And there we are. Okay, that is.
I closed their voices, but
all right.
if it is okay,
Yes.
I can intervene from here.
Okay, super.
Okay. As I said, when we are speaking about the stock exchange valuation, we are speaking about the real sector stocks, the companies which are producing, the companies which are trading. Okay, it is not like a dreamland. It is real market. Okay, Microsoft selling the Microsoft products, the computers, the software, or the Intel selling their chips, or the Amazon making their supply chain products. Okay, so when we are speaking about the world equity valuation, we are speaking directly the real market indicators throughout the world. So the world equity valuation, as you see on the left-hand side, I will try to briefly explain those details, but this is directly MSCI World Forward PE ratio. Let me explain what is MSCI. MSCI is Morgan Stanley index throughout the world. And the forward PE meaning price earning ratio. Okay, this will show you how the market is cheap or expensive. This is a directly indicator when you are buying. Let's say you have a money, you have an idea to invest in a stock or in an index. Okay, this is like buying a house. This is like buying a car. If you are buying an index, you want as an investor, it is cheap while you are buying, and the prices should go up in the near future to make you a profit. So what type of indicator, Dr. Dogan, I should check while making investment decision in financial market, especially in stock exchange? The first and best well-known indicator is PE, as I said, that's one. PE, price earning ratio. While we're speaking about the price earning ratio, it is showing that, as you see in here, this is world indices. And on the y-axis, as you see, y-axis, you will see the price earning ratio, and on the x-axis, as you see, the time, the year, from 1990s till today, approximately 34 years period. And if you see this dashed line, this dot, this is showing an average for this 30 years. What does it mean? During this 30 years, world index price earning ratio average is 16.3. So if the prices earning ratio, as you see, like here, above the average, this means that stocks are expensive. Is this point clear? I will repeat this point again. As you see here, from 1995 till 2000, if the price earning ratio at that time is higher than the average of those times, this means that the stocks and equities are expensive today. Or the reverse, as you see here. If the price earning ratio is less than the average, this means that everything is cheaper in the financial market, go and buy. Okay, you can directly make a comment while making your own investment decision in this sense. If the line is below the average, this is showing in price earning ratio that stocks are cheaper. And if the line is above the average, you can directly comment on it that these are expensive and not the good time to buy it. And as you see here, at the end of 2023, the current price earning ratio is 17.4, even a little bit subtly above the average ratio. So it is around the average. And now, if I look at, as you see here, if I look at the equity and credit yields, what does this mean? Look at this one. What the y-axis showing me? It is percentage yield. What does this mean? If I buy something, what will be the next year expectation in percentage yield? What will be my profit? What will be my return in this investment? And as you see here, this one, the blue one, is global BBB credit yield. What does this mean? BBB or AAA, what does this show? As the people who are taking macroeconomic and finance course, at least I think you know that three biggest credit rating agencies in the world, credit rating agencies like S&P, like Moody's, like Fitch. These are three biggest credit rating agencies in the world. And they are making a rating for the governments, economies, sovereign debt, treasury yield, and they are giving a note. And their note is like A plus, AA plus, B, BB plus, BBBB. These are showing where you are and how you are credible. And if the note is below this BBB 3B level, this means that not the investment level. What does this mean? If you invest your money in this country, it is highly risky. Okay. So if it is above the B3B ratio credit rating, this is an investment grade to buy this. And for this level, as you see, around today, we have 6% yield in the world. And for the equities, as you see, normal returning is around 8%, but today it is around 6% as well. And my question is that at the end of the classes, at the end of the presentation, I will answer this question as well. But now, for now, please think this. Why the equity yield, as you see, developed market equity yield, okay, developed market equity yield, this green line, why it is earning, why it is yield is higher than the credit yield. Why it is high? One of the questions I will answer at the end of the session is this. Okay, please remember me if I miss and forget this point, because this is one of the most important points you should keep in mind. And let me explain now, and at the end of the section, I will emphasize this point again. While making investment decisions, we look three things: liquidity, risk, and return. Three things, okay? Liquidity, risk, and return. Liquidity means that if I want to buy or sell something just now at this second, can I buy this $100 million with the same price, or can I sell this $100 million with the same price? Liquidity is this. If the market is not liquid, and if you see a price on the screen, and if you want to sell your investment at that price, $100 million, you will sell it approximately 10% discount if the market is not liquid, because nobody will buy it. No deepness in the market. Okay. So liquidity showing how the financial market is liquid and deep. Second, risk. How my investments bring a profit and write a loss for me. For instance, if Dr. Walchin put his $1 million to fixed income securities. What does this mean? He is buying a US 10-year treasury. Okay, United States treasury bonds he is buying. Is any risk there? No. If the United States living there, treasury will pay back this money in any case. No risk. But if you buy a stock, let's say you buy a small company in your country and CEO decided to close this investment, factories, etc. You will lose all of your money. Let's say Amazon today decided to stop all operational around the world. For instance, you see on the screen that Amazon stock price is 300 today. If Amazon decided and declared to the market, in 5 days, you will see Amazon prices as $10, approximately 90% loss. Because stocks are risky. Okay, their volatility is really high. Their profit, their yield is high, their loss is also high. In two sides, it is volatile. And third things is return. How much money I will get, how much money I will lose. And as you see in this green line, because the stock exchange and equities are risky and volatile, their return is also high. Always keep in this mind. If something giving 1 year return to 1%, and if something giving you to 10% in the same period, the second one will be risky. Otherwise, nobody will give you 10 times higher. Okay, nobody will offer you 10 times higher return if everything is safe. There should be something different. And the difference here between these are risk. Okay, volatility. Please keep this in mind. And now, please look at this chart first. Try to understand what is trying to explain in those two charts. I think another voice, but I don't. Dr. Watson, I couldn't see it there.
We're having that problem again. I don't understand. Oh, man. And I have begged the participant to help out somehow.
I think we can also write this in chat side as a warning. Please don't open your microphone or something like this.
I'll do that. You may continue. I'll take care of that as well.
Okay, okay. Right, please. I'm here.
You there, Professor Duggan? I'm losing you, but your mic is on.
Dr. Walshi.
Yes, I can hear you now.
Here, but I'm taking a water because of my throat.
Ah, okay. I didn't realize that. Ladies and gentlemen, I'm reminding you that you are with Atlantic
Okay, sorry for this.
University and the presenter, Professor Abdulkadir D. The first developments from the first quarter of the market for this year, 2024.
Exactly. Now, let me restart again the second slide.
Okay.
As you understand that PE ratio showing how much the market is expensive or cheaper. And as you see in global forward price earning ratio, now in the first slide, this is world average. Okay, don't mix the mind. This is the world average. I'm taking the average of the world and now deciding which one is how much the world economy, the world stocks are cheaper or expensive. This is directly just one side of the game. But now I'm differentiating the markets, as you see here. I'm differentiating the market, global forward PE. And now this is world. This is US. This is Europe, excluding the United Kingdom after Brexit. This is United Kingdom. This is emerging market. And this is China. Please look at this chart. And remember how I'm making comment about average and current ratio. And what can we say about today? Which market is cheaper and which market is expensive to invest in the stock exchange? Could you briefly mention this and understand this difference? For instance, as the world, as you see, look at this green dot. What it is saying in the definition? Average since 1990, meaning that 30 years average is this green dash. And this blue dot is showing what is it currently. And this bar in the black side showing the range during the 34 years. And as you see, world is almost similar to their average. So not expensive, not cheap. But as you see, the United States current is absolutely higher than its average. So the stocks I closed.
Okay.
If I see somebody, I'm directly closing. But if you wanna ask some question, please keep your question in your mind. After approximately 15 minutes, 20 minutes, I will give the microphone to you and you will ask all your questions. As you see, what I'm saying, let me take this side. United States. The United States current PE ratio is here and average is here. What does this mean? The stock in United States is expensive today because its current price earning ratio is absolutely higher than its average. Okay, United States stocks are expensive. And for the Europe, it is not cheaper, not expensive, almost on the average line, but a little below. But for the United Kingdom, as you see, the average for the 34 years is here, but the current price earning ratio is here. What does this mean? United Kingdom stocks are really cheap. Please invest there, not in the United States, but in the United Kingdom. Or emerging market economy. The average is here, but the current is here, meaning that emerging market also cheap. Or the China, absolutely cheaper, right? So if I have money and if I will put this money into the stock exchange, I will not buy US or Europe stocks. I will buy emerging markets, United Kingdom and China. Okay, keep this in mind. And as you see here, relative equity valuation. What does this mean? This percentage relative discount premium based on 12-month forward PE ratio. What does this mean? How much my money is cheaper if I buy this? How can I earn? How much money more I can earn in this economy? And as you see, this orange line showing the China versus the United States, meaning that China is cheaper than 50% of the United States stock. Or if I compare Europe with United States with purple line, Europe is approximately cheaper than 30% than the United States. And if I compare United States with United Kingdom, United Kingdom is cheaper approximately 45% than the United States stock. Okay, please keep these graphs and tile how you make your investment in your mind. And now I will try to explain the regional earning expectation and profit margin. Consensus estimates for global earning per share growth. These meanings that this earning per share growth is EPS. Okay, we are calling this as EPS in financial one. And this consensus estimate showing how much this EPS will grow in the world. Look at this. For the world, in the 2024, it's approximately 8%. For the US, 11%. But for the Europe, it is just around 5%. For the UK, it is around 8% again. And for the, let's say, the emerging market economies, what does it mean? 18% EPS growth, earning per share. They will create huge profit with their production and talent. So please buy the emerging market stocks. They will earn huge money. And because you are a shareholder there, you will earn money as well, because the stock price will rise. And in China as well, around 15% earning per share growth will be expected during the 2024. And now, on the right-hand side, by the way, remember my question. Dr. Kadir, we have money, we want to make investment. What we will check in the financial market? The first one is this, price earning ratio. The second one is earning per share, EPS. And the third one is profit margin. What does this mean? You have a company and you are producing something, but your company never produced any profit. Is there anybody invest your company? No. Nobody will invest to your company because you are not producing any profit. Because while you are making investment, you are telling to the investor that I will make profit and we will share this profit. You will get dividend. But if you don't have profit, nobody will buy your company's shareholder. Okay, so profit margin is absolutely in an important point while making a decision in investment, especially in stock exchange. And as you see here, again, the profit margins here. Okay, let me change the style. Profit margins here on the right-hand side. And as you see, the light blue is the United Kingdom. The purple one is the Europe excluding the United Kingdom. And the black one is United States. Now, we can ask this question to our own selves. If we are also checking the profit margin in the stock exchange side, and if the profit margin is also another important indicator to make a decision while buying the stocks, if the United States is really profitable, why we are not buying those stocks but this? Because world economies are interconnected. Nobody can write the profit at the end of the life. Nobody can lose the money at the end of the life until that end of life. This is a circle. This is a cycle. Okay. So in this boom bust cycle, you will sell the expensive and you will buy the cheap. If you are holding 3 years, during 3 years, if you are holding United States stocks, sell it here and buy these emerging markets here, because United States is expensive here and the emerging market is cheaper here. Always the basic strategy. Sell the expensive and buy the cheap. Okay? This should be kept in mind. And now we have the relation of the regional styles to 10-year treasury. What we mean by 10-year treasury yield and how it is different from the stock exchange. 10-year treasury yield is a securities and bond, government bond, which is saying to their shareholder or investor that in any case, if the government of the United States is alive and there, you will get your money back with their interest return. There is no default probability. Okay, the United States will pay all of your money at the end of the maturity. This is 10-year treasury. And if you buy, as I say, a stock exchange, even you can lose all of your money tomorrow if the company go to bankrupt. Okay. For that reason, treasury yield is as a fixed income security, riskless, fixed return, and everything is there. No volatility, everything is less risky. Basic definition, low volatility, less risky. And here, as you see, from different sectors, and we are trying to look at the correlation between the MSCI sectors to 10-year treasury yield. And as you see here, energy, financial and industrials, and materials on the top. Meaning that, look at the definition, 10-year correlation of sector relative performance with 10-year treasury yield, meaning that sectors tending to outperform when yields are rising, meaning that if the yields are rising in 10-year treasury, energy, financial, and industrials are really performing better in the stock exchange. But if you buy the healthcare, consumer staple, consumer discretionary, real estate, IT, or common communication services, you will lose your money if the interest rate increasing in the market. Okay. And now, we have global equity sector weight. What does this mean? If you buy a United States indices, let's say you are taking a position in Nasdaq Stock Exchange, and you just directly buy the Nasdaq index, not the stock, but index. You should know how much the allocation of the different sectors in this index. What is the weighting of the sector? And look at it. IT in the United States is approximately 30%. And financial, approximately 14%. Healthcare is 14%. Consumer discretionary and industry is around 10%. So if you buy indices in the United States, you are directly buying a IT sector weighting. But if you're buying, let's say, United Kingdom, let's say United Kingdom, as you see the blue, light blue dashed line here, the bars, showing a fair distribution of the different sectors. None of them is above the 20%, and none of them is almost less than the 5%. Almost everything is around between 5 and 20%. For that reason, if you buy the United Kingdom, you are making a differentiation of the sectors and risk diversification. For instance, if you buy an United States index, and if the IT sectors in the world perform worse, you will lose huge money, because most of your money will be in the IT sector because you are taking position in the United States. But if you take the position in the United Kingdom, your risk diversification and sector allocation will be better. And as you see here now, this is MSCI World Growth and Value sector. What we mean by growth and value? Growth and value in stock exchange are two fundamental descriptions of the sectors and stocks. If I am speaking about the growth, this will be something like a startup. This will be something like making investment and grow in the future. But if I am speaking about the value, value means that the water from the mountains flow and reach the fields. Okay, smooth. They have a value, like Amazon, like Microsoft. They don't have to prove themselves. They have a brand. They have a value. Their stock price does not increase hugely, but does not drop hugely as well. Okay, they have a smooth path. They have value. They are not growing too much. But the growth sectors, as I say, like startups, like the sectors and stocks who are making huge investment today, they are growth. Okay, keep this in mind. And now we are speaking about the global equity income. Dividend payout ratio, as you see, by the way, please look at the recent period because we are trying to speaking about the first quarter development here. And dividend payout ratio, as you see here, almost increasing all around the world. Why? And why it is decreasing, for instance? Why the dividend decreasing here in this period, all the world? Because of the COVID. Nobody sell anything. Nobody make a profit. If there is no profit, there will be no dividend. Okay, if I have a profit, I will share this profit with my shareholder and they will take their dividend. But if I don't make any profit, nobody will get any dividend. So In the crisis period, as you see in two global financial crisis, and as you see here in the COVID-19 crisis, we have huge dividend yield decrease throughout the world. But now, as you see in the first quarter of 2024, the dividend yields are trying to cover themselves and their loss during these loss years, especially in the COVID period. And equity market factors. Now, S&P 500 quality and S&P 500 relative performance. Please look at this gray dashed line. These are, as you see in the definition, these are directly showing the recession. 1919 gold crisis, 2000 dot-com crisis, 2008 global financial crisis, and this thin line is COVID-19 global crisis. Okay, these are the recession period. And during the recession period, S&P quality and S&P relative performance is absolutely increasing. Look at here. Look at here. And please look at here. Because relative performance and quality performance make a differentiation between themselves. The companies who are strong, who have huge turnover all around the world, and does not sensitive any shock to the financial or real market, they make their quality differentiation, especially in the crisis period and recession period. And if you look at this MSCI World Growth and Value for PE ratio, as you see here, what we say, growth meaning that like startup, they increase their turnover each year doubling, but the value is smooth. Value meaning that I have smooth turnover, I have smooth profit margin, operating margin, EBITDA margin. My everything is value, not growing. Okay, so the value indexes, as you see, price earning ratio is around 15-12%. Okay, but for the growth sectors, as you see, the growth sectors during the COVID-19, their price earning ratio reached around 32. Huge amount, 32. And now we will speak about, let me take just one glass of water because of my throat.
All right. I want you to be sure, ladies and gentlemen, that you are in super solid and sure hands with Atlantic International University. The details we are now getting from Professor Abdulkadir D are fundamental in the arena of finances. We're talking about types of information that you would get from huge encyclopedias in that field. So you should take full advantage of that. I also want to remind you that the entire PDF document will be posted on your student portals very soon after the presentation. You may continue, Professor Dugan, reminding you as well that I leave in exactly 20 minutes.
Yes, thanks a lot. Thanks a lot.
You're welcome.
Everybody can ask their question because after approximately 5 minutes, I will give the microphone to them.
Okay.
As you see here, the oil, Brent oil, world taxes, crude oil prices, and US rig count. As you see here, USD per barrel. And by the way, if you see the oil prices in the market, and if it is decreasing, just think that there is a risk in the market. If the gold price is increasing, there is a risk in the market. If Brent petrol decreasing, if gold price increasing, there is a risk in the market. Okay, you can directly think this in this sense. Look at here. From 140, the per barrel price is decreasing to 40. Or look at here, in COVID crisis. From approximately $80, the price is almost decreasing to $20 per barrel, meaning that there is a risk. Okay, if the oil prices is decreasing, there's a risk. Risk appetite meaning decreasing. If the oil price is increasing, everybody all around the world increasing their risk appetite. Okay, they are buying everything. And as you see here, crude oil production with the countries, as you see, OPEC is in the top, and the United States here. And look at the trend in the 2024. The Saudi Arabia and Russia is almost flat, but the United States and the Iran is increasing their crude oil production per barrel in the world. And the commodities, as you see, real 10-year treasury yield and gold. As I say, if gold price is increasing, look at this one, gold is here and orange. If gold price is increasing, the risk is increasing. Okay, and this is US 10-year treasury yield, and this is reverse. Please look at this. This is reverse. Okay, if the yield is increasing, this is minus, this is plus. So if this is going down, this means it is increasing in the black. Okay, this is reverse cycle, reverse axis. For that reason, gold price is decreasing and yield return is increasing, meaning that there's a risk in the market. Or the commodity price for the crude oil, agricultural products, and industrial metals, as you see, they are smooth during the first quarter of the 2024, but still there is a risk because I want to give the priority now this one. As you see, there are lots of challenges in 2024 first quarter in the slide. But now you should understand this. What the financial market challenges on these days on the agenda? What the everybody thinking all around the world? What is the main risk? Main risk is this. In the June monetary policy meeting, European Central Bank will start to decrease their interest rate because Europe going to a recession if the interest rate will be above 4.5%. Nobody buying anything, nobody investing anything with the cost, and Europe going to a recession. So ECB started to decrease the interest rate. But the United States Federal Reserve still stubborn to decrease the interest rate because the employment market is really good in the United States. No recession signal all around the world for their United States indicators. For that reason, they want to be a little bit patient to still wait until the inflation decreases to their targeted band of 2%. European Central Bank also want to do so. They also want to wait. But if they wait more, they will lose the employment market and they will go into recession. They are not lucky as much as the United States. But US today is really lucky. Their employment market is perfect and they can wait until the end of the year to decrease the interest rate. For that reason, with the higher interest rate, nobody will buy any mortgage, nobody will buy any stocks, nobody will buy anything with this type of cost in the deposit and investment banking. For that reason, in the next couple of months, the main question will be this. If the European Central Bank starts to decrease the interest rate, how this will happen and affect the stock and Euro USD parity in FX market, foreign exchange market, and what will happen next if the United States does not decrease the interest rate until the end of the year. And in next week or 2 weeks later, we will cover these topics as well as the second quarter challenges and developments in the financial market. Now, this is the end of the slide and the microphone at your hand. You can take your microphone. You can take all your question and ask. I will try to explain all those questions.
Thank you very, very much. I love that you are a very, very practical, pragmatic man, pretty much exactly how an educational session should wrap up or unfold. Man, you've done a truly phenomenal job. Thank you, Professor Abdulkadir D. On behalf of the entire family or institution of Atlantic International University, I want to thank each and every one of you as well. Very cherished attendees. And now this is your time. You have a solid 12 minutes to ask questions. You may do that like Professor Abdulkadir D stated, either by speaking up, raising your hand and letting us know that you want to ask a question, or through the chat line. If you type your question in there, I'll go ahead and read it for both Professor Dugan and the entire group of participants. This is Atlantic International University providing you with those extra learning opportunities. What you get from every session is not necessarily for each academic major, those of you who are current students, but they are critical pieces of information that can apply everywhere, whether you are in the field of finance, you are in theology, you are in geography, business administration, electrical engineering, you name it, you can apply finances in those fields. So we are ready for your question at this time, ladies and gentlemen. For that participant who just requested that we drop a copy of the PDF document on the chat box, Professor Dugan can do that. But I remind you, very dear friends, that every presentation is posted on your student portal. If your portal is active, the entire or full PDF document will be available within your student portal. Again, we are ready, ladies and gentlemen, for your questions. I was gonna say I don't see any, but yes, we have two questions as a matter of fact. Oh la la, I see three hands up, and I'm looking at the chat channel. Let me begin with the chat channel real quick. I love that question, Professor Dugan. Why is the USA considered the richest country in the world? What's your answer to that question, Professor Dugan?
Why the US is considered as the richest country in the world?
Yeah.
We take these two concepts. First, the gross domestic product. Look at
Okay.
this, please. Let me share my screen again. Here my screen.
Why is the USA considered the richest country in the world?
I think everybody see my screen now.
Yes, yes.
And here, as you see, I take two things. First, the overall GDP, meaning that $26 trillion. And look at this one. For instance, if you look at these other things, as you see, for instance, for the Canada, it is just $2 trillion. Or for the Russia, or let's say for the Turkey, it is just $1 trillion. But in the United States, it's 26 trillion, meaning that 26 times higher, more income. But the most important thing is not that. The most important thing is this: per capita GDP, meaning that look at the India. They are huge economy, like higher than the Canada. But their per capita GDP is just 2,600. But in United States, it's 80,000. Okay, the richness is not the how big you are, how developed and wealthy.
Yes.
Okay.
Yes.
For instance, in China, you have this, but the average income is nothing. Okay. So being rich means that not the government. You will be rich as household.